Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. I wanted to update the video I did yesterday on sequence of return risk. I feel like I left something important out. So we showed this chart, three portfolios composed of a different combination of stocks and bonds, starting with $500,000 each, using the 4% distribution rule. In other words, taking out 4% the first year, or $20,000, and then adjusting it every year thereafter for inflation. So what did I leave out? What I left out was the fact that stocks and bonds did about the same for the 18-year period, or from 2000 through 2018. The S&P 500 did 4.86% annualized, and the Bloomberg U.S. Aggregate Bond Index delivered a 4.84% return. So why should these portfolios perform so differently if they're composed of two asset classes that did about the same for the whole period? And the answer is that stocks were more volatile. They dropped a lot in the first years, 2000 through 2002, and then they dropped a lot in 2008. And a portfolio that's undergoing distribution, where you're pulling money out of it, cannot recover when the stock market recovers. That's the crucial issue here. It's not that stocks and bonds perform differently. They didn't. They performed virtually the same, 4.86 versus 4.84. The difference in these portfolios is that the stock market was more volatile, and you can't handle volatility when you're taking distributions out of a portfolio. That's why the 100% stock portfolio left you with 200,000 at the end, starting with 500,000. The 60-40 portfolio in the middle left you with about 400,000 at the end after starting with 500,000. And the 30-70, the very conservative portfolio of 30 stocks, 70 bonds, left you just about intact with the 500,000 that you started with. The reason for that disparity in these three portfolios is not at all that the asset classes perform differently on an annualized basis. It's that they performed differently from year to year and had much different volatility profiles. Volatility will kill you when you're distributing money from a portfolio, even if the average annual return winds up being a decent number, or the same number as bonds, which are inherently less volatile than stocks. So that's what I wanted to show you, that it's the volatility of the stock market that killed you, not the bad returns. Compared to bonds, it didn't have bad returns. It had the same returns virtually. Anyway, sequence of return risk, that's the real story. John Camarianos signing off for Capital Considered from Rehoboth Beach. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.